looking at a rate cutting cycle that's bullish for gold, and we're already at or near record nominal prices. So we're not going into a bullish scenario from gold from some cyclical multi-year low. We're going into a bullish period for gold from a multi-year high. I think that's a fantastic setup. And as a speculator, the best thing of all possible worlds about that is that while the gold dollar exchange ratio, gold price is up, many of the gold stocks are still in the doghouse. So you'd think it's too late. You'd think you'd missed the boat. But there's actually outstanding opportunities to profit from gold breaking out, and the people who've been expecting gold to break down to realize their mistake and pile into those stocks. There's an enormous slingshot effect here. I am personally looking forward, well, I'm positioned for already, but I'm looking forward to deploying more cash.
Gold prices retreated slightly after reaching a new record high earlier on Thursday, hovering just above the $2,200 mark during the first half of the European trading session. Despite the pullback, gold remained positive for the second consecutive day. Independent speculator Lobo Tiggre views the current market environment as conducive to investing in gold, particularly in gold stocks. He highlights the potential for further price appreciation and perceives gold-related equities as undervalued relative to the price of gold itself. On Wednesday, the Federal Reserve's decision to maintain its projection of 3 rate cuts for the year weighed on the US dollar for the second consecutive day, consequently boosting gold prices to a fresh all-time high. Akash Doshi, Citi's North America head of commodities research, expressed optimism about gold's prospects, suggesting that prices could reach $2,300 per ounce in the second half of 2024. This outlook is supported by expectations of potential rate cuts by the U.S. Federal Reserve during the same period. Currently, gold is trading at $2,203. Tiggre emphasizes gold's historical resilience as a store of value relative to currencies, particularly during periods of currency devaluation. For instance, the price of gold in euros has surged by 555% since the creation of the euro. While gold prices may exhibit short-term volatility, its stability is a long-term investment option compared to other assets. This stability hedges against currency fluctuations, minimizing losses and optimizing investor returns amid currency volatility. Join us as we delve into Gary Wagner's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
If you run a correlation with gold and CPI, it's pretty low. My friend David Lynn over at the David Lynn Report likes to push back on me on this, and he frequently shows in our interviews a graph of the gold price, or the gold dollar exchange ratio, as I call it, versus the inflation rate. And it looks like there's no correlation at all. And the reason for that is that gold leads. When people get afraid about what's happening to the purchasing power of their money, they sell it and buy gold. So it tends to lead. And we saw this beautifully illustrated in 2020. Before inflation went to 9%, that's when gold hit its first new nominal all-time high since 2011. Gold led. And then by the, a couple of years later, we get inflation screaming up and gold is going sideways. So if you look at inflation going flat and gold going up, there's no correlation there. If you look at gold being flat and inflation going up, there's no correlation there. So the correlation, it seems like, well, gold is a terrible inflation hedge. There's no correlation with gold. Consider that it leads, though, then that changes. And again, my starting point, if you step back, look at the big picture, that giant X between gold and the dollar over the last 70 years, of course, gold is an inflation hedge, or rather, gold is what it is. It has value. And as the little colorful pieces of paper and the electronic traces of them that we call money lose value, then that shows up in the so-called prices of gold. It doesn't make sense in the real world, but in la la land on Wall Street, it makes sense. Oh, the Fed is cutting rates. That's good for gold. There's some confabulation possible in here. Gold as a safe haven does well in recessions. The Fed tends to cut rates in recessions. So is it really the rate cutting and this idea that gold doesn't pay interest that's at work here? Or is it really just gold being a safe haven and doing well in recessions, which is when the Fed tends to cut rates? And so, it might not be the variable. It's sort of like people think, or they don't really think, but there's this myth that sunny weather causes parking tickets. Because in the rain, you don't get parking tickets. In the sun, you do. Well, it's because in the rain, the cops stay home. In the sun, they go out and they get parking tickets. So it's not the sun that's causing the parking tickets, it's the cop. And so it might not be the rate cuts that are causing gold to go up. It might be the recession, which are sparking the rate cuts. So I don't know how long you want me to play Professor Wolf here. There's a lot of different threads to tease apart. My takeaways from this would be, one, don't lose sight of that big picture. Just look at a 70-year chart of the value of the dollar versus the so-called price of gold. That giant X marks the spot you want to be in. Looking at a rate cutting cycle, that's bullish for gold. And we're already at or near record nominal prices. So we're not going into a bullish scenario from gold from some cyclical multi-year low. We're going into a bullish period for gold from a multi-year high. I think that's a fantastic setup. And as a speculator, the best thing of all possible worlds about that is that while the gold dollar exchange ratio, gold price is up, many of the gold stocks are still in the doghouse. So you'd think it's too late. You'd think you'd missed the boat. But there's actually outstanding opportunities to profit from gold breaking out, and the people who've been expecting gold to break down to realize their mistake and pile into those stocks. There's an enormous slingshot effect here, which I am personally looking forward. Well, I'm positioned for already, but I'm looking forward to deploying more cash into.
In 2023, the People's Bank of China emerged as the top buyer of gold among central banks, with the World Gold Council attributing this trend to China's struggling economy and the challenges faced by its real estate sector. As a result, more investors turn to gold as a safe haven asset, with individual gold investments remaining robust. Following closely behind, Poland's central bank secured its position as the second largest net consumer of gold by acquiring 130 tons of bullion in the same year. Meanwhile, Singapore also made significant strides in gold purchases, with the Monetary Authority of Singapore leading the charge by acquiring 76.51 tons. LoboTiggre emphasizes the significance of central banks' continued gold acquisitions, noting that such buying activities reflect enduring confidence in gold as a reserve asset. However, he warns that a significant reduction or cessation of central bank purchases could signal a shift in the dynamics of the gold market. Substantial gold purchases by central banks underscore strong market demand, contributing to predictions that gold prices could climb to $2,300 per ounce by late 2024. Let's get back to the interview.
What would make me turn bearish enough on the gold dollar exchange ratio to cycle out of gold stocks? A no landing scenario could do that. If I'm completely wrong about the hard landing and we get this no landing scenario and there's a growth cycle, so you've got no demand for safe haven, that could potentially have me say, you know what, it's time to start reallocating in a different direction. However, in these particular, that would be the general answer. But in our world right now, in 2024, where central banks are still buying record amounts of gold, I made this bearish call, short-term, not permanent, but short-term bearish call on gold last summer. It was right, but it was very muted. The circumstances, the gold stocks sold off. Gold itself, should have sold off given everything else that was going on, but it didn't, because the central banks kept buying. At least it seems to us, in hindsight, it looks like the central banks made up for the loss from other people selling. And, right now we have these outflows in the ETFs while gold hits new nominal highs. So who knows? We're in uncharted waters. If the central bank buying keeps on going at these levels, and by the way, that doesn't just go away. Even if the next president kisses and makes up with Putin and the war goes away, and that doesn't make China suddenly decide to trust the Fed with its transactions and its savings, or other countries. So I will pledge to our audience that if we're looking at something, I've become convinced we're looking at something like 2012, where the cycle has peaked and the odds are some, long slide downwards, a multi-year bear market. I don't want to go down with the ship, and I don't want anybody listening to me to go down with the ship either. I would definitely look to lighten up on my gold stocks. And in that circumstance, in that no landing, if that takes over the narrative, I'll be happy to have uranium in my portfolio. I'll be looking to add copper and other things that will do well in an economic boom. And hopefully that'll make up for me being slow to get out of gold, because I'll be slow. I mean, it'll take some convincing before I'm sure we're there. Silver will follow gold, but with a lag. And silver is also, this is the Darth thesis, right? It's increasingly industrial metal. And if I'm right about the hard landing, then that's a weight that's going to hit silver harder this year than gold. But gold, it has industrial uses, but very little. Silver is still money. Silver reacted very strongly to geopolitical news as a monetary metal. I thought it was, there's nothing good about what happened in Israel and is happening in Gaza now. But it did show that monetary metals plural, gold and silver, reacted to geopolitical tensions in a way that other industrial metals, even precious ones, rare ones, did not. And so this is very recent confirmation that silver is still a monetary metal. So yeah, I'm kind of giving you two answers here. I'm not sure how much that is helping, but I'm not in a hurry to buy more silver stocks right now. I think there'll be time to get on board if we see that that's happening. I'm mostly focused on the two yellow metals, gold and uranium right now.
Looking ahead, what are the main factors or events that you believe will continue to influence gold prices shortly? Are there any potential risks or uncertainties that investors should consider when considering gold as part of their investment portfolio? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.